Imagine Marcus makes $100,000 a year. He has no debt. He wants a $300,000 loan to buy a house. On paper, everything looks perfect. Good income, no debt, same loan amount. But when Marcus walks into the bank does not only look at his income. They look at one number that can completely change the deal, his credit score. And this is where most people get shocked. Two people can make the same income. Two people can have the same debt. Two people can apply for the same loan. But if one person has a higher credit score, they may get a much better interest rate. And if the other person has a lower credit score, they may pay thousands or even hundreds of thousands more in interest over time. That is why your credit score matters. It is not just a number on an app. It is the number lenders use to decide how risky you look. And if you are off by even one credit tier, it can cost you real money. Hey folks, welcome back to the channel. My name is Marcus, and in this video, I am going to show you how to boost your credit score using 5 key methods that can help move you closer to that sweet 850. Now, I want to respect your time, so if you cannot watch the full video, here's the quick version. If you are new to credit, start with a beginner credit card. Use it responsibly, make your payments on time, pay in full, and do not overspend. That alone can start building your score the right way, and if you already have established credit, the same rule still matters. Pay on time, pay in full. Keep your balances low. But if you want to understand the actual levers that move your credit score, stay with me, because I am going to break down the 5 parts of your credit score and show you what you can actually control. Let's start with what a credit score really is. The easiest way to think about it is like a GPA. In school, your GPA was a number that showed how well you were performing academically. Now, people can debate whether GPA really shows intelligence or not, but that is a different conversation. Your credit score is similar. But instead of showing how smart you are in school, it shows lenders how responsible you are with borrowed money. That is it. The higher your score, the more trustworthy you look to banks and financial institutions. The more trustworthy you look, the better your interest rates can be. The lower your score, the riskier you look. And when lenders see you as risky, they usually charge you more money through higher interest rates. So now let's talk about the 5 major parts of your credit score. I am going to start with the smaller factors and work my way up to the biggest ones. The first component is hard inquiries. This usually accounts for around 10% of your credit score. A hard inquiry happens when you apply for new credit. That could be a credit card, an auto loan, a mortgage, a personal loan. Anytime a lender pulls your full credit report to review your profile, that can show up as a hard inquiry. Now, a hard inquiry by itself is not the end of the world. It is normal to apply for credit sometimes, but if you apply for too many accounts in a short period of time, lenders may see that as risky. It can look like Marcus is desperately searching for credit, and when lenders see that, they may ding the score a little. The good news is, hard inquiries do not last forever. They usually fall off your credit report after about 2 years, and most of their impact is usually strongest in the first few months, so I would not panic over one inquiry, but I would avoid applying for random credit cards and loans for no reason. Now there is one exception. If you are shopping for a mortgage or auto loan, multiple inquiries in a short window may be treated as one inquiry depending on the scoring model. That is because the system understands you are rate shopping. So if you are buying a car or a house, do not be scared to compare rates. Just try to do it within a short window. Another tip is to freeze your credit reports when you are not applying for anything. You can freeze your credit with Experian, TransUnion, and Equifax. Then when you actually need to apply, you can unfreeze it. This can help protect you from unauthorized pulls. Now, how do you use this to boost your score? Simple. Do not apply for too much new credit too quickly. And if you see a hard inquiry you do not recognize, you can dispute it with the credit bureaus. If you did not authorize it, the bureaus may need to verify it, and if it cannot be verified, it may be removed. The second component is credit mix. This also accounts for around 10% of your score. Credit mix means the different types of credit accounts you have. There are two main types: revolving credit and installment credit. A revolving account is something like a credit card. The balance can change every month. You use it. You pay it. Then you can use it again. An installment account is something like a car loan, mortgage, student loan, or personal loan. You borrow a fixed amount. Then you pay it back with scheduled payments over time. Lenders like to see a mix because it shows you can handle different types of credit. If Marcus can manage a credit card, a car loan, and a mortgage responsibly, lenders may see him as more experienced. But here's the warning: do not go buy a car or take out a loan just to improve credit mix. Credit mix is only a small part of the score. It is not worth taking on unnecessary debt just for this. If you already have student loans and you add a credit card, that can create some mix. If you already have credit cards and later add a mortgage or auto loan because you actually need one, that can help too. But never borrow money only to chase points. The third component is length of credit history. This is usually about 15% of your credit score. This looks at things like: how old is your oldest account? How new is your newest account? What is the average age of all your accounts? The logic is simple. If you have a long history of using credit responsibly, lenders feel more comfortable. If your profile is very new, lenders have less data to judge you on. This is why older accounts can be valuable. They show history. They show consistency. They help your credit profile look more established. Now, one question people ask all the time is, should I never close a credit card? The answer is a little more nuanced. If the account is your oldest card and it has no annual fee, try to keep it open if you can. That old account can help your credit age. But if you opened a newer card, you do not use it, and it has no real value. Closing it is not always a disaster. If the card is closed in good standing, it can still stay on your credit report for years and continue helping your history for a while. But here is where closing a card can hurt you faster. It can hurt your utilization. And we are going to talk about that next. So for credit age, the main strategy is simple. Keep your oldest positive account open if possible. Avoid opening too many new accounts at once. And let your accounts age. Time is part of the credit game. You cannot hack everything. Sometimes you just need consistency. The fourth component is credit utilization. This usually accounts for around 30% of your score. And even though it is not the biggest factor, it is one of the most powerful because you can control it quickly. Credit utilization means how much of your available credit you are using. For example, if Marcus has a credit card with a $5,000 limit and he uses $1,000, that is 20% utilization. The general rule people hear is to stay under 30%. And yes, under 30% is better than being maxed out. But personally, I would keep it as low as possible without reporting zero on every card. The lower your utilization, the safer you look to lenders. Because if you are using a lot of your available credit, the lender may think you are relying too heavily on debt. And that makes you look risky. Now, this is also why closing a credit card can hurt your score. Let's say Marcus has 2 cards with a combined limit of $10,000. Then he has a $3,000 balance. That is 30% utilization. But if he closes one card and his total limit drops to $5,000, that same $3,000 balance becomes 60% utilization. He did not spend more money, he did not miss a payment, but his utilization doubled because his available credit went down. That is why closing cards can hurt quickly, not always because of age, but because of utilization. So how do you improve utilization? First, pay down your balances. Second, try to pay before the statement closing date. This is important. Your statement closing date is usually when the card issuer reports your balance to the credit bureaus. That date is not the same as your due date. If your card reports your balance before you pay it down, your report may show high utilization even if you pay in full later. So if you want the bureaus to see a low balance, pay before the statement closes. For example, if your statement closes on the 25th, try to pay your balance down a few days before that. Then the lower balance is what may get reported. But do not always report zero on every single card. FICO has explained that showing some responsible credit usage can be better than looking like you are not using credit at all. So a common strategy is to let one card report a tiny balance, maybe 1%. Then pay it off before the due date. That way, the bureaus see low usage and you still avoid interest. The fifth component is payment history. This is the biggest factor. It usually accounts for about 35% of your score. And it is exactly what it sounds like. Do you pay your bills on time? Lenders care about this the most because past behavior is one of the strongest signs of future behavior. If you have a history of paying on time, lenders trust you more. If you have missed payments, lenders see more risk. Now here is something many people do not know. If you miss a credit card due date by 1 or 2 days, that does not usually show up as a 30-day late payment on your credit report. But you can still get hit with a late fee, and you should not play games with this. Because once a payment becomes 30 days late, that can seriously hurt your score. So the best strategy is simple. Automate your payments. If your bill is due on the 5th, set autopay before that date. At minimum, set autopay for the minimum payment so you never accidentally go late. Then you can manually pay the rest if you want. If you do miss a payment by a day or two, call the credit card company. Ask for a one-time courtesy fee waiver. If it is your first time and your account is usually in good standing, they may refund the fee. But do not make this a habit. Payment history is too important. Now let's put this together. Payment history is around 35%. Utilization is around 30%. That means those two categories together make up about 65% of your score. This is why the simple advice works. Pay on time. Keep balances low. If you do those two things consistently, you are already handling the biggest parts of your credit score. The other three factors still matter. Hard inquiries matter. Credit mix matters, credit age matters, but they do not usually matter as much as payment history and utilization. So if Marcus wants to build a strong score, the plan is simple. Avoid unnecessary hard inquiries. Keep a healthy mix of credit without taking on debt for no reason. Keep old positive accounts open when possible. Keep utilization low. Pay before the statement closing date, and never miss a payment. That is how you build credit the right way. Not with tricks, not with fake hacks, not by opening random accounts, but by understanding what the score is measuring and controlling the parts you can control. If this helped, drop your questions below and let me know what credit topic you want next.